Imagine knowing almost nothing about business as a child, except that money could grow if you treated it wisely. Imagine buying your first stock before becoming a teenager. Imagine turning a few $1,000s into a fortune worth more than $100 billion without inventing a revolutionary technology or becoming a famous entertainer. This is the story of Warren Buffett, a man who proved that patience can be more powerful than speed. A man who became one of the richest people in history by making decisions that most people considered boring. While others chased trends and quick profits, Warren Buffett quietly built an empire that changed investing forever. But what makes his story so incredible is that he did not start with special advantages that guaranteed success. His greatest weapon was the way he thought. Long before he became known as the Oracle of Omaha, Warren Buffett was simply a curious kid growing up in Omaha, Nebraska during the Great Depression. He was born on August 30th, 1930, into a family that valued hard work and discipline. His father, Howard Buffett, worked as a stockbroker and later became a member of Congress. His mother, Layla Buffett, managed the household during one of the toughest economic periods in American history. Money was not always easy to find, and the struggles of the Great Depression shaped the way Warren looked at the world. Instead of spending everything he earned, he became fascinated with saving and multiplying his money. Most children collected toys. Warren collected ideas about business. By the age of 6, he was already buying packs of Coca Cola and selling individual bottles for a profit. He quickly realized something important. Small profits repeated over and over could become something much bigger. That lesson stayed with him for the rest of his life. As he grew older, his curiosity became almost an obsession. He delivered newspapers, sold chewing gum, sold golf balls, collected and resold used items. Anything that could make money caught his attention. By the time he reached his teenage years, he had already earned thousands of dollars through small businesses. Many adults had never saved that much money. At just 11 years old, Warren bought his first shares of stock. He purchased shares of City Service Preferred. Soon after buying them, the stock price dropped sharply. He became nervous and sold after the price recovered slightly. Not long after selling, the stock climbed much higher. That painful experience taught him another lesson. Patience is often rewarded. Throughout his life, Buffett would remember that moment whenever markets became unpredictable. While other teenagers spent their weekends relaxing, Warren studied financial reports. He read books about investing for hours every day. He especially loved one book called 1,000 Ways to Make $1,000. It convinced him that wealth could be built through creativity, discipline, and consistent effort. By the age of 16, Buffett had saved the equivalent of well over $100,000.
In today's money, his journey was only beginning. After high school, Warren wanted to continue learning about investing. He first attended the University of Nebraska after briefly studying at the University of Pennsylvania. Even though he was an excellent student, he felt that traditional education could only take him so far. What he truly wanted was to learn from the greatest investor alive. That investor was Benjamin Graham. Graham had written a book called The Intelligent Investor. The book completely changed Warren's understanding of business. Instead of chasing exciting companies, Graham believed investors should buy strong businesses selling for less than they were truly worth. This idea became known as value investing. Buffett was fascinated. He applied to Columbia Business School because Benjamin Graham taught there. Getting accepted changed his life forever. Under Graham's guidance, Buffett learned how to evaluate companies based on facts instead of emotions. He discovered that the stock market often behaves irrationally. Prices can rise and fall because of fear, excitement, and speculation. But the real value of a business depends on its earnings, management, competitive advantages, and future potential. These ideas became the foundation of everything Buffett would later accomplish. After graduating, Buffett worked briefly for Graham in New York. It was his dream job. Every day, he analyzed businesses, searching for companies selling below their true value. He absorbed every lesson he could. When Graham retired, Buffett returned to Omaha. Many people expected him to build a normal career. Instead, he decided to start investing on his own. In 1956, Buffett created his first investment partnership. He convinced friends, family members, and a few local investors to trust him with their money. He promised to work harder than anyone else to find great investments. His approach was simple: protect the downside, stay patient, only invest when the opportunity is obvious. Year after year, his partnership produced exceptional returns. While most investors worried about short-term market swings, Buffett focused only on long-term results. His reputation spread quickly. People realized he was seeing opportunities that others completely ignored. Then came one of the most important decisions of his entire career. A struggling textile company called Berkshire Hathaway caught his attention. At first, Buffett only intended to make a short-term investment. The company was cheap, and he believed he could make a quick profit. But after disagreements with management, Buffett decided to buy control of the company. At first, this seemed like a mistake. The textile business continued to decline. Many people wondered why such a brilliant investor would own a failing business. Buffett later admitted that buying Berkshire Hathaway was not his best decision, but instead of giving up, he transformed the company into something completely different. Rather than focusing on textiles, Berkshire became an investment company. The cash generated from its businesses was used to buy shares in outstanding companies across America. Over time, Berkshire Hathaway invested in insurance, railroads, energy, manufacturing, retail, and many other industries. One of the smartest moves Buffett ever made was buying an insurance company called National Indemnity. Insurance companies collect premiums long before they pay claims. This creates large amounts of cash, known as float. Buffett realized he could invest this money while waiting for future claims to be paid. That strategy gave Berkshire enormous financial power. As the years passed, Buffett invested in companies with products people used every day. He bought major stakes in Coca Cola, American Express, Apple, and many other iconic businesses. Instead of chasing hundreds of different investments, he focused on owning great companies for decades. His philosophy was simple: it is better to own an amazing business for a long time than constantly buy and sell average companies. This patience separated Buffett from almost everyone else on Wall Street. While markets panicked, Buffett remained calm. When investors rushed to sell during financial crises, Buffett searched for opportunities. He believed fear creates bargains. During the financial crisis of 2008, many companies struggled to survive. While uncertainty dominated the market, Buffett invested billions of dollars into companies that others were afraid to touch. Those investments later generated enormous profits. His ability to remain rational while others became emotional became one of his greatest strengths. Another remarkable part of Buffett's story is his lifestyle. Despite becoming one of the richest people in the world, he continued living in the same Omaha house he bought in 1958. He avoided unnecessary luxury. He often ate simple meals. He preferred reading books over attending glamorous parties. Every day, he spent hours reading annual reports, newspapers, and business books. He believed knowledge compounds just like money. The more you learn, the better your decisions become over time. People often asked Buffett about the secret to success. His answers were usually surprisingly simple. Read constantly, think independently, avoid unnecessary debt, surround yourself with honest, intelligent people, focus on your reputation because it takes decades to build and only minutes to destroy. One of his most famous partnerships was with Charlie Munger. Munger became vice chairman of Berkshire Hathaway and helped Buffett evolve as an investor. Instead of buying only cheap companies, they focused on buying exceptional businesses with durable competitive advantages. Their friendship lasted for decades and became one of the greatest partnerships in business history. Buffett also became famous for his annual letters to Berkshire shareholders. These letters were written in clear language, without complicated financial jargon. Millions of investors around the world studied them because they contained timeless lessons about business, investing, and life. Even though Buffett accumulated extraordinary wealth, he made another historic decision. He announced that he would donate the vast majority of his fortune to charity. Working alongside people like Bill Gates, he launched efforts encouraging billionaires to give away most of their wealth during their lifetimes. His belief was that enormous fortunes should eventually benefit society. Today, Warren Buffett remains one of the most respected investors in history. His success was never based on luck alone. It came from thousands of careful decisions, repeated consistently over many decades. He never searched for shortcuts. He never believed getting rich overnight was realistic. Instead, he trusted the power of discipline, patience, and continuous learning. Perhaps the greatest lesson from Warren Buffett's life has nothing to do with money. It is about thinking differently. When everyone becomes emotional, stay calm. When everyone follows the crowd, think for yourself. When everyone wants instant results, remember that the biggest rewards often belong to those willing to wait. His journey proves that ordinary habits, repeated consistently, can create extraordinary outcomes. A young boy selling bottles of Coca Cola grew into one of the greatest investors the world has ever known. Not because he was the fastest,
Not because he took the biggest risks, but because he understood something that many people never do. Success is rarely built in a single moment. It is built one smart decision at a time. And that may be the most valuable investment lesson of all.